Welcome to the Series 7 Top-Off Exam audio lessons. This is lesson number 5. Now, before we get on to this lesson, which is primarily going to be about the Securities and Exchange Act of 1933, I wanted to do a little more review on sales literature for bond mutual funds. So there are a few required disclosures when you're talking about bond mutual fund volatility, and we covered these in a previous lesson, but I just want to summarize them quickly for you. So what has to be included when you are disclosing bond mutual fund volatility ratings to your customer is, if you're giving them a rating, the date of the current rating, the links to the website where it will describe the criteria to arrive at the volatility rating, a statement that there is no such standardized method to determine any volatility rating, because all these firms come up with their own ratings, a description of the types of risks contained in the volatility ratings, whether it's a long-term volatility, a medium-term volatility, or a short-term volatility. This needs to be described in the rating. And finally, a statement that there's no guarantee that volatility rating will not change. Okay, and for a money market fund, because quite often clients have money market funds tied directly to their brokerage account, the prospectus or any advertising material for the money market must contain this statement. An investment in the fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund. All right, they're just trying to make sure that your customer, your client, is aware that a money market fund does carry risk. Now, back in 2008, when we had the collapse in the stock market, there was a very close time when the money market fund was going to break $1. And that was a big deal. And that's part of the reason the Fed jumped into action and started bailing out banks, was the fear that if the money market funds broke, there would be a mass run on the bank to get their money out of the money market funds. So that did not occur, but they are setting up your client and making sure your client is aware of the fact that that is a possibility. Let's talk one more time about investment company rankings. So if you're going to be talking to your client about investment company rankings, in other words, mutual fund rankings, again, we're going to go over this. You can't advertise that it's the best in its ranking unless it really is the best in its ranking. Whatever type of fund it is, such as a growth fund or a balanced fund, whatever type of fund it is, it has to be disclosed. The ranking entity's name, and if there's any affiliation of the company, of the investment company, with the ranking company, the criteria for the ranking, such as, is it a total return, a growth-based ranking, an income ranking, what's the ranking for it? Prominent comment that past performance is no guarantee of future results. That's one you always see. You probably have that memorized if you watched any advertising of mutual funds on TV or heard it on the radio. And the ranking based on the life of the fund up to 10 years. So if the fund's only been around for 1 year, you have to show its 1-year ranking. If it's been around for 5 years, you have to show its 5-year ranking. If it's been around for 10 years, you have to show a 10-year ranking. I don't think you have to show anything beyond 10 years. All right, that's going to cover what I wanted to review before we get on to the Securities and Exchange Act of 1933. The Securities Act of 1933. There's basically 3 acts that you're going to be, maybe 4 acts now, 4 specific areas of legislation that you will be tested on the Series 7. The Investment Company Act of 1940, the Securities Act of 1933, the Securities Act of 1934, and probably the Dodd Act as well. But the Securities Act of 1933 came about as a result of the crash, the stock market crash of 1929. And the intent of the Securities Act of 1933 was to make sure that people had enough information to make reasonable decisions on investments. Additionally, it attempted to curb speculation in new issue securities by preventing the ability to margin stock or borrow against the new issue securities. Now, when you're buying and selling stock in a regular account, typically you can margin your securities to the tune of about 50%. In other words, you'd have to come up with about half the money to buy 100 shares. If you wanted to buy 100 shares of a stock, you'd really need to only come up with about 50% of the money needed to buy 100 shares, and you'd borrow the rest at broker interest rates. There's a specific interest rate that brokers charge clients' accounts to loan them money to buy it. I don't do this for my clients, but some people do. That'll be your choice, and it'll be dependent on your clients. That's called margin, and we'll get into that in much more detail in later podcasts. But the Securities Act of 1933, the first thing it did was say, well, first of all, we need to make sure there's full disclosure on the risks and information about the issuer of the new securities, the new issues in particular. So it required a registration statement for all securities except exempt offerings. And exempt offerings are another whole area of investments that we will talk about. And typically an exempt offering falls under a certain subsection of the Securities Act of 1933. We'll talk about that a little later on. But for all new issues that are publicly traded new issues, a registration statement was now required and had to be made available to the investors theoretically prior to the offering. Now, in practicality, my experience has been you would have, if you really were lucky, a red herring, which is called a preliminary prospectus, and that's a common term used for it, is the red herring. And the difference between the red herring and the final prospectus was the final prospectus would have the actual offering price and the number of shares sold. A red herring is a preliminary prospectus which does not price of the offering because it hasn't been determined by the investment bankers. And it doesn't have the total number of shares issued because usually when a new issue is offered, they will offer a certain amount of shares and also allow for an overage to sell an additional number of shares. And the final prospectus would tell the total number of shares that are sold and the final offering price on the new issue. So the registration statement, the prospectus, is a key document. And quite often when I want to go back and really learn about a company, when I'm doing research in a company, I will go back and find the original prospectus. Fortunately, now with the internet, we can go back in time and get these documents. When I first started out in the business, if you didn't have it in your library, it was very difficult to get. Nowadays, it's easy. So it's easy to go back and get the initial prospectus or registration document of a company when they went public. It's called basically the prospectus, the initial offering prospectus. So when companies do an initial offering, they disclose a lot of information. They give information on the background of the officers and directors. They give a management discussion on what the company does. It goes into great deal, who the competitors are, audited financial statements. It will talk about its competitors and how it sees itself in relation to its competitors. And then there will be an absolutely huge section on the risks of the offering. And they throw everything in this. Currency risk, liquidity risk, business plan risk. The reality is they try to, if you read a prospectus and you read the risk section, you would say, why would I ever invest in this stock? And that's the intention of the disclosure document, to make sure you have a full understanding of the risks involved in investing in a new issue. And also, it's a way of companies to cover their rear end, so to speak, when the inevitable lawsuits occur if the company doesn't perform. We live in a very litigious society, and lawyers make sure that every possible scenario is disclosed. Every possible scenario they can think of is disclosed in the risk statement of a prospectus. And that's so that they can cover their rear end. They can't say that, well, they can't have somebody come to them and say, well, this risk wasn't disclosed, because it would have been disclosed in the risk statement of the prospectus. So the procedure is the company files a registration statement with the Securities and Exchange Commission. The Securities and Exchange Commission reviews the registration statement, and as long as everything is fully disclosed, then the company enters into a 20-day quiet period. And that's assuming that the SEC feels that there is a full and fair disclosure in the registration statement. That might be a term you want to learn, full and fair disclosure. So during that 20-day cooling off period, the issue cannot be sold, it cannot be advertised, it cannot be recommended, and orders to buy or sell cannot be solicited. Now let's assume that the SEC found that there was not full and fair disclosure. At that point in time, the SEC would send a deficiency letter back to the company and require additional disclosure, and the 20 so the company has to refile the registration statement addressing the concerns of the SEC. And once the SEC states that there is full and fair disclosure, then the 20-day cooling off period begins. Now, during the 20-day cooling off period, the company may allow the underwriters to distribute the preliminary prospectus. That's not considered advertising. That's called the preliminary prospectus we discussed, the red herring. And this is not considered an offering. It's just considered a dissemination of information on the company. Now, what happens at this point in time, and you can go back and see Facebook and Google, is during this 20-day period of time, people call up their brokers and say, hey, I want some of this stock, or I'm really interested in this stock. And brokers or underwriters can put together a list of people that are interested in the stock, but they are not allowed to distribute the stock until the company finally goes public after the 20-day cooling off period. So nobody knows during that 20-day period of time whether they will get any stock or not. After the 20-day period of time that the SEC feels that there has been fair and full disclosure, or full and fair disclosure, I don't know if it matters one way or the other, the way you say it, but at that point in time, the registration is effective. And now orders can be taken and stock can be sold, as long as the sale is made through the final prospectus that should be available at that point in time. Now, according to the Securities and Exchange Act of 1933, a purchaser must have or must get a final prospectus prior to the confirmation of sale. And in reality, how that typically works is an order is taken and a prospectus is mailed out, and the money is paid for the stock, but in reality, and this has been my experience, clients can renege even though they paid for the stock by saying they never received a prospectus. In my experience, in my personal experience, this has occurred a few times in the past. And what happens is the broker now has to make up the difference, because the broker has to go in on the open market and cancel the trade. That's been my experience. Sometimes the company will stand behind the broker, don't count on it. Companies are notoriously self-serving, and their attitude will be that if you don't have a client that knew about the full risks of the underwriting prior to time, it's going to be your money and not the company's money that pays for it. That's been my experience. That's not in the Securities and Exchange Act of 1933. But that seems to be how the world works in reality. When that has happened to me, I just never deal with that client again. End of story. The client is not an honorable person. In our business, your word is your bond. And I will not be fooled twice. The company has a 90-day period of time following the effective date to deliver the final prospectus to the customer. and the prospectus does go out. But again, it's a catch-22 situation. If you sold the stock subject to the prospectus, the client really doesn't get the prospectus. So this is a very gray area in securities regulation. This is supposed to be how it works. It's supposed to be said that the client buys the stock and must get the final prospectus prior to the confirmation of sale. But then the company has days to get the prospectus to the client. Now, this is only on an initial public offering. This does not apply in secondary offerings. In a secondary offering, the company has 40 days to deliver the final prospectus. Now, that was the original Securities and Exchange Act of 1933, but since then, there's been a shortening of the prospectus delivery period to 25 days for exchange-listed stocks and NASDAQ-listed stocks and global market issuers. Following the initial public offering, there's what's called a quiet period. And during this period of time, underwriters can't recommend the stock, research analysts can't recommend the stock, insiders can't buy or sell the stock, officers can't sell the stock. The company cannot comment on its operations. So this is what's called the quiet period. Now, let's say a company does not make full disclosure. Under the Securities and Exchange Act of 1933, that's considered fraud. And, of course, that's what most the class action lawsuits are based on, is lack of full disclosure in the prospectus. And if it's considered fraud, it involves everybody dealing with the issue, and this would include the lawyers, the accountants, the underwriters. And so lawyers, accountants, and underwriters, when they're getting involved in new issues, will do their own due diligence and charge the company for their efforts in doing their due diligence. So when you think of the Securities and Exchange Act of 1933, think of full disclosure, prospectus, registration statement, red herrings, full disclosure. That's the main concept of the Securities and Exchange Act of 1933. Now, what are exempt transactions under the Securities and Exchange Act of 1933? Well, government and municipal issues are exempt. Insurance companies are exempt because they're regulated under state law. Bank issues, which are covered under state banking laws, are exempt, which predate the Act of 1933. If a common carrier, such as a railroad, trucking company, is covered under the Interstate Commerce Commission that predate the Act of 1933, those are exempt. Nonprofit issues, benevolent organizations, farmers' cooperatives are exempt. Nonprofit educational and charitable organizations are exempt. Bankers' acceptances, small business investment companies are exempt. Commercial paper is exempt as long as it's shorter than 270 days. If an offering is only done intrastate, within the state, and does not cross state boundaries, it's exempt. But if you have one person that lives in another state that buys the security, then it falls under the Securities Exchange Act of 1933. Private placements, Regulation D, are exempt. That's called Regulation D, and there's a whole section that covers private placements. And to be buying a private placement, you have to be an accredited investor. We talked about that in a previous podcast. What is an accredited investment? Basically, Regulation D is offered privately. It's not a public offering. And if you want to read the actual rules that cover this, this is SEC Rules 501 to 506. In a Regulation D offering, a maximum of 35 non-accredited investors are allowed into the issue. But you can have as many accredited investors, and accredited investors, again, we'll go over this again. Individuals with a net worth of $1 million, individuals with an annual income of $200,000 a year for the past 2 years, or a couple with a joint income of $300,000, and a reasonable expectation that this level of income will continue. Financial institutions such as banks, insurance companies, mutual funds, and nonprofit institutions with assets in excess of $5 million. Now, in a Regulation D exempt offering, there's not a dollar limit on how much can be sold or the number of units sold or the number of states in which it's sold through. But they do have to provide a private placement offering circular, which is very similar to a registration statement and needs to make pretty much the same disclosures as a registration statement. What they avoid in a private placement is having the Securities and Exchange Commission pass on the document. How much are companies required to disclose? It really just depends on how much they're offering. If the Regulation D offering is not greater than $1 million, no specific information is required. But remember, even though no specific information may be required, if you don't make enough information available to your investors, you're subject to lawsuits. If it's, let's say, between $1 million and $5 million, then audited financial statements have to be included, and there's other specific information that must be included, and that's under Rule 505. Now, just because an investor is accredited does not necessarily qualify him to be purchasing a exempt offering. In addition to being accredited, the investor must be considered sophisticated. In other words, he has to have the education and the wherewithal to make a reasonable, educated decision on the investment offering. An idiot with a great net worth would not be considered a sophisticated investor. And if the issuer sold the offering to a non-sophisticated investor and they lost money, remember, this only happens if they lost money. A lawyer could make a charge that offer should not have been sold to that individual because he was not a sophisticated investor. He may have been accredited but not sophisticated. And when you buy into a private placement offering, you have to sign a document that states that, number one, you are accredited, and number two, you are sophisticated. You have the education. Sort of a self-certification letter. I don't know that anybody's going out there and investigating the individual, but it's a self-certification, and that's going to be the primary document in any defense against a lawsuit. If an issue is done in the state, an intrastate offering, there's a 9-month period of time after the effective date when the offering cannot be sold to an out-of-state buyer of the stock. So it restricts the ability for individuals in a private placement to resell their stock if it's an intrastate offering for a 9-month period of time. An intrastate offering is exempt under Rule 147 of the Securities Act of 1933. And an intrastate offering still must comply with whatever the state requirements are for an offering. So it's not totally exempt from regulation, it's exempt from federal regulation. When a company files an intrastate offering, they must file a Form 147 with the Securities and Exchange Commission at least 10 days before. And Regulation D is basically the Form D that is used in filing a private placement offering. So quite often companies use Regulation D to raise money and to develop a company. I think there's been a lot of large companies that's how they started out, as private placements. And the individuals that invest in these private placements can sell the stock to other individuals, but there's no public market. And any new individual that buys the stock must fall into the same category. In other words, a accredited and sophisticated investor if there's an exchange of stock between individuals. So the stock can be sold, but it can only be sold privately, not publicly. But let's say the company is growing and growing and growing, and probably a good example of this is Google, and eventually they decide to go public. A couple reasons they want to go public. Number one is to give liquidity to the initial investors that invested in the company. And number two, they need to raise additional capital for expansion, continued expansion of the company. So a company goes public with a new registration document. This one is a registration document that is a fully public, fully registered document. It goes public. Now, the people that invested prior to the company going public are, so the insider that owns that private placement stock, after the company goes public, now owns a publicly traded stock, but he can't publicly trade his stock. His stock is still restricted under Rule 144. And there's certain procedures that he has to go through to make that stock fully trading. And that stock is often called lettered stock, 144 or lettered stock. To sell the 144 stock, the holder of that stock must have held that stock fully paid for at least 6 months. And then he may begin to sell his stock. But he's not allowed to sell the stock more than 4 times a year, once every 3 months. And the maximum amount that he can sell is limited. It's either 1% of the outstanding shares of the company at any one time, or the weekly average of the 4 weeks trading volume preceding the filing of his Form 144. And that's the form that he files to sell the stock. Now, there's some stocks that are publicly traded where there's no records kept of the volume of the stock. It's traded through bulletin boards or electronic exchanges, and there's no tabulation of the volume of stock. So in that case, what the SEC has said is that you can dribble it out, but no more than 1% of the stock every 90 days. So if an insider owned 20% of the stock, he could dribble out 1% of the total stock every 90 days. You can do the calculation. It'd probably take him about, 1,800 days to sell all 20%. Now, there's 144 stock, and then there's control stock. And control stock is stock that is held by officers and directors of the corporation. Control stock, if an officer wants to sell stock, he has to make full disclosure of his intention to sell that stock, and he has to report the sales of his stock and what it was sold at. So what is control stock? Stock held by officers and directors, and also any 10% shareholders or affiliated persons, such as relatives of an officer. So a control person can either sell under 144 but make full disclosure, or they may register a secondary offering, which is done once in a while, where they sell their stock in a registration document. You as a broker can order us to buy or sell 144 stock. You may, however, act as an agent for a client that does own 144 stock. And I've had to do this in the past, and it's a headache. And why you do that is because you're hoping that the client will become a valuable client and do business with you in the future. If you're going to jump through all the hoops that are required to take the letter off 144 stock, you're hoping that the client will reward you in some ways. Sometimes it works, sometimes it doesn't. There's a couple other things that we might want to talk about on 144 stock. There's also a small offering rule where any 90 days, if the person owns a small amount of stock, he can sell up to 5,000 shares, but not worth any more than $50,000 every 90 days without a filing statement. This person must be a small, very, very small holder of the overall stock outstanding of the company. And what's small is really not defined. But again, it's no more than 5,000 shares worth no more than $50,000 every 90 days. Now, let's say that you're a insider, you're a investor in 144 stock, and you die. Well, your estate is not subject to the 144 rules. They can sell the stock without going through the 144 restrictions. Still, they're going to have to get the legend lifted off the stock, and there's procedures for doing that. But you're not restricted to the 90-day rules. And, of course, the reason the government wants this to happen is because of inheritance taxes. They want to be able to get their money. They want to get their hands on some of that money themselves. There's Rule 144A that allows large institutions that have at least $100 million in discretionary assets to invest in restricted stock, in 144 stock or private placement stock. And they can trade these through brokers and dealers. And there's a specific area. The NASDAQ has an electronic marketplace for 144A stock. And again, this is tradable private placement units for qualified institutional buyers. And typically these are sold in increments of at least $500,000 per trade. So the big institutions don't fall subject to the same 144 restrictions that individuals do, and they will trade 144 stock between themselves. The last thing covered under Securities and Exchange Act of 1933 was Rule 145, and this deals with reorganizations. company's gone bankrupt, it wants to reissue new stock. This is done through another registration statement under Rule 145. And typically what's going to happen under Rule 145 is it will exchange old stock for new stock. You might have owned 100 shares of the old stock, and now under the reorganization you get 1 share of the new stock. I've seen this done in the past, and that's done under Rule 145. What's not covered under Rule 145 are stock splits, stock dividends, normal corporate transactions like that, or a change in the par value of the stock. Par value really doesn't have much to do with stock anymore. It's still there. Some states charge a tax on the par value of the stock. That's why a lot of companies just issue no par stock. All right. Now that you've listened to this whole long lesson of the Securities Act of 1933, let's talk about a few things that are specifically contained in the outline for the Top-Off Series 7 that you may need to review in addition to what's been talked about already, and we're just going to emphasize these things. So Section 5 of the Securities Act of 1933 prohibitions relating to interstate commerce and the mails. So basically it says that it's illegal for the sale or delivery after the sale of any unregistered securities unless there's been a prospectus on it. Basically, unless it complies with the Securities and Exchange Act of 1933 or is excluded by one of the exclusions contained in the Securities Act of 1933. So continuing on here, basically it talks about using the mails, and it is illegal to try to sell unregistered securities through the mail. But basically it's saying that you cannot sell securities through the mail unless they are registered securities under the Securities Act of 1933. So it is unlawful. It shall be unlawful for any person directly or indirectly to make use of any means or instruments of transportation or communication in interstate commerce or of the mails to offer or sell or offer to buy through the use or medium of any prospectus or otherwise any security unless a registration statement has been filed as to such security, or while the registration statement is subject to a refusal order or stop order prior to the effective date of the registration statement, any public proceeding or examination under Section 77H of this title. All right. And then there are limitations, and I'm going to read this. Notwithstanding any other provisions of this section, an emerging growth company or any person authorized to act on behalf of emerging growth company may engage in oral or written communications with potential investors that are qualified institutional buyers or institutions that are accredited investors, as such terms are respectively defined in Section 230.144A and Section 230.501A of Title 17. So basically that's saying you can go ahead and talk to potential investors through the mail or through the phone or through any form of communication as long as they are an accredited investor or an institution that falls under the exclusions. So angel investors are one of those that are typically accredited investors, and they are investing in non-registered, non-publicly traded stock that's common for angel investors, and this is the exclusion that they always rely on. So basically that's what Section 5 is talking about. You can't use the mails or communications to sell unregistered securities to the general public. That's it in a nutshell. Section 156 is basically talking about the investment company sales literature and what must be disclosed in that sales material. I'm going to summarize the points. It can't be misleading. So basically, Section 156 talks about sales literature, investment company sales literature, and bottom line it says any of this sales literature that is provided may not be misleading. And lawyers often go to this when they file lawsuits against firms stating that under Section 156, some of the material in the sales literature was misleading, and this is what they sort of hang their hat on. So basically, bottom line, is you can't provide misleading information to your customer. And it goes through and gives specific examples of this, but I think that basically summarizes it. You cannot provide misleading in sales material of investment company sales literature. And then Section 498 talks about prospectuses of open-end management companies. We will talk about open-end mutual fund companies in a future episode. So that should be about what you need to cover for the Investment Company Act of 1933. All right, thanks for listening to this sample lesson. If you decide you want to purchase the full bundle of audio lessons, go to series7podcast.com, and that's series and the number 7, so series and the number 7 podcast.com. Click on the Series 7 Top-Off Study Guide, Audio Lessons for the new Series 7 exam, and it will take you to a service called Gumroad. Gumroad will take your credit card information and then send you an email link where you are allowed to listen to or download the MP3 files. Let me strongly suggest, that you take the time to download the individual audio files into your computer. The total length of this full series of audio lessons is 32 hours and 27 minutes. So download all the MP3 files to your computer and then take the time to upload the individual MP3 files that you want to listen to back to your listening device. This would take up a lot of storage space to put the full series of audio lessons onto your listening device. I provide in the download a PDF document which explains how to go through the process of downloading the MP3 files to your computer and then uploading them into your listening device. And I'm assuming by listening device, you're talking about an iPhone or another smartphone of some sort. You can also do it into the old-fashioned iPods if you want to do that. Gumroad does have an app which you can use to listen to the audio lessons, but I think you will have a lot of problems using the app. It has not been updated in quite a few years. I'm hoping that Sahil Lavinga, the founder of Gumroad, will be upgrading this app in the near future. But until then, if you want to purchase the full series of audio lessons, the best way to do it is to download it into your computer and then upload the individual MP3 files into your listening device. Now, a lot of people have asked me why I don't put the full series of audio lessons out on, let's say, a service like Audible or iTunes. Well, if I did that, they take such a big portion of my revenues that I would probably have to more than double the price that I charge you for this series of audio lessons. I try to keep the price reasonable and affordable to you. And if I uploaded it to those services, I just wouldn't get enough to justify the trouble that I go through to put these audio lessons together. All right. Best of luck in your studies. I hope you find these audio lessons